Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Paladin Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
When you look at the recent chart for Paladin, the phrase that just springs to mind is corporate resurrection.
Oh, absolutely.
We're talking about a stock that saw a nearly, 58% jump in a single day? That signals a massive reversal of investor sentiment.
It does. But you can't talk about the current price, which is trading solidly around that $22 mark, without looking at the journey they just survived.
It was an absolutely grueling one.
That's right. The recent jump isn't just about a new drug. It's the market saying, okay, you navigated some major corporate hurdles.
So let's break that down, because it wasn't that long ago that Paladin was, staring down a potential delisting, a terrifying scenario for any investor.
Exactly. The low point really came back in August. They were forced to execute a 1-for-50 reverse stock split.
A 1-for-50 split. And for anyone who isn't familiar, what does that actually mean?
It means they basically consolidate every 50 existing shares out there into one single new share. And it's generally seen as, well, a move of last resort. You do it to artificially boost the share price back above that minimum requirement to stay listed.
And it's just a huge psychological blow, right?
Yeah.
It signals desperation, liquidity dries up, traders move away.
That's precisely what happened. They were temporarily suspended from the NYSE American, had to move to the OTCQB market. That was, the moment of maximum risk.
But they used that time to pull off a couple of key wins.
2 absolutely critical strategic wins. That's what drove the whole turnaround.
So what was the first one? I would argue, the most crucial validation point.
That would be the major collaboration with Boehringer Ingelheim in October. This deal wasn't just scientific validation. It was immediate, desperately needed revenue.
How much are we talking?
It included an $8.8 million immediate revenue recognition for that quarter.
That initial payment is key. But the real story, the thing that gets institutional investors excited, that's the future potential, right?
Yeah, that's where the massive milestone payments come in. The deal is structured with potential payments that could exceed $320 million.
Wow.
And that covers development, regulatory commercial steps, plus tiered royalties on top of that.
Now, biotech milestones, they're not guaranteed. So to help everyone understand, what does that $320 million actually mean? What kind of hurdle gets you one of those big payments?
Great question. The biggest ones are usually regulatory and commercial. So think about successfully starting a phase 3 trial. That's a major trigger.
Okay.
Getting FDA approval for the drug. That's a huge multi-million-dollar trigger right there. And then, the first commercial sale. The fact that the $320 million covers the whole life cycle tells you Boehringer is investing in the entire platform.
So the Boehringer deal gave them validation and cash. What was the second major step that let them get back onto the NYSE American?
That was the strategic capital raise in November. They did an upsized public offering, generated about $18.2 million in gross proceeds.
And they earmarked that money, didn't they?
They did, and crucially, they earmarked it for their obesity pipeline and for working capital.
Right.
That's a strong signal. It tells investors the money is going into R&D, not just keeping the lights on.
Right.
So that cash, plus the Boehringer revenue, it boosted their shareholder equity. It solved the core problem. And by mid-November, they'd regained compliance and were back trading on the NYSE American. That sequence is the engine behind this price spike.
And when you look at the chart now, the technicals are all reflecting this. The stock is above both its 50-day and 200-day moving averages.
Which is the textbook definition of a confirmed uptrend.
Yeah.
And if you look at momentum, the RSI, the Relative Strength Index, is sitting comfortably in that 60 to 70 band.
Which means there's strong buying interest, but it's not overbought yet.
Exactly. It suggests there's potential institutional accumulation, but it still has room to run before a sharp pullback is technically signaled.
So that brings us to the core value here. The corporate drama is in the rearview mirror. The long-term thesis now is all about the science.
It is. Paladin's real advantage is its focus on the melanocortin system platform. It's a complex system that regulates inflammation, sexual function, and most importantly right now, appetite and metabolism.
It's a less crowded space.
A much less crowded space than, say, GLP-1s. It gives them a proprietary edge.
Okay, let's pivot to the pipeline then. Starting with obesity, because that's where all the excitement is.
Yeah.
What are their key assets?
Their flagship candidate is PL7737. This is an oral MC4R agonist that's moving toward the clinical phase. They're also developing combination therapies bremelanotide with GLP-1s.
Okay, hold on. We are just inundated with news about GLP-1s, Wegovy, Zepbound. What exactly is an MC4R agonist, and why is an oral option such a big deal?
That's a crucial distinction. GLP-1s, they primarily work by slowing digestion and making you feel full. MC4R, the melanocortin-4 receptor, is different. It's a key regulator in the brain that directly controls your energy balance and appetite. An agonist activates it, which leads to reduced food intake and increased energy expenditure.
So it's a completely different pathway.
Precisely, which means it could be complementary or maybe even superior, and the oral part is huge. I mean, if you can develop an effective oral option, you solve one of the biggest bottlenecks in the current market, which is patient reluctance to self-inject.
The market definitely wants non-injectable solutions.
Desperately.
But their pipeline isn't just a one-trick pony. They have ophthalmology programs, too, which helps de-risk the company, right?
That's their smart strategy. They have multiple programs on the same platform for chronic eye diseases. PL9654 and 965B5 are for diabetic retinopathy.
The leading cause of blindness.
Exactly. And PLN9588 is for glaucoma. These are serious markets with high unmet need.
And diabetic retinopathy is a silent epidemic tied right into the rise of diabetes. If they can show a disease-modifying property there, the value is just enormous.
It is, and the confidence here isn't just speculation. Their credibility has been boosted by positive data presentations at major conferences, Obesity Week for the weight loss assets, and ARVO for the eye programs.
So they're showing the data.
They're showing robust preclinical and early clinical results, efficacy, safety. That's what gives a company like Boehringer the confidence to sign those $300 million plus deals.
But this kind of R&D across multiple disease states is incredibly expensive. We've seen the corporate turnaround, but what do the fundamentals look like?
That's the crux of it, isn't it? Looking at the snapshot, you've got strong positives and some inherent risks.
Okay, let's start with the good news.
On the positive side, their trailing 12 months, or PTM revenue, is at $8.85 million. And that reflects them turning their IP, that Boehringer deal, into recognized revenue.
And what about dilution? Because that's a killer in biotech.
And here's maybe the biggest green flag. Their shares outstanding are incredibly stable at 14.7 million, virtually unchanged from 2024.
So they raised $18 million without flooding the market with new shares.
Which is a powerful signal that management is focused on protecting per-share value. That's rare.
It is.
Yeah.
But there's still pre-commercialization. What's the profitability picture look like?
The short answer is they're not profitable yet. They reported a TTM net income loss of about $4.81 million.
Okay.
But the good news is those losses are narrowing. It shows they're getting more efficient and that the cash they raised is being spent wisely on those key clinical programs.
So it all comes down to execution, which brings us to the primary risk factor, pipeline risk.
The pipeline risk is the single largest potential headwind, always is in biotech.
Yeah.
You can have a phase 2 trial failure, an unforeseen regulatory outcome, and it can instantly wipe out market cap no matter how good the early data looked. And R&D costs can always exceed projections.
So getting those partnerships is key to spreading the risk.
It's absolutely critical.
The technicals suggest the market is optimistic right now. But what should we be watching for in the near future? What are the key catalysts over the next 3 months?
The next 3 months are packed. The immediate event is the fiscal Q1 2026 earnings report, scheduled for early December.
And investors will be looking at what?
Not just the top line. They'll be scrutinizing sequential revenue growth and, more importantly, the cash runway after that equity raise. They need to show they have enough cash to get to the next big data readout.
And beyond the balance sheet, we need to see scientific progress.
Absolutely. Look for concrete pipeline milestones. We're expecting updates on the advancement of their obesity and sexual dysfunction programs.
Any specific data releases?
Any new data from that oral MC4R asset, PL7737, or the diabetic retinopathy assets? That would be a major catalyst. Clinical data trumps everything else.
And given the success with Boehringer, another deal would be massive.
That's probably the most powerful near-term catalyst. The company has explicitly said they're pursuing more out-licensing collaborations. Securing even one more partnership would provide non-dilutive funding and serve as third-party validation that the whole platform has broad appeal. That de-risks everything.
We also have index events coming up.
Correct. The major ETF rebalancing in late December is significant. Being back on the NYSE makes them eligible for inclusion in biotech or small cap ETFs.
Which improves liquidity and visibility.
And brings in a wider institutional investor base. It can create a natural support for the stock price.
Okay, finally, we have to touch on the buzz. The speculation that always comes with a turnaround story like this.
Of course. And while it is purely speculative, the chatter is heavy around potential M&A interest.
Merger and acquisition.
Right. The logic is sound. They have a differentiated platform, a proven partnership with a major player, and assets in the hottest sector, obesity, with a hedge in ophthalmology. That makes them a pretty attractive target for a larger firm looking to buy a pipeline. So the investment thesis for Peloton, it really hinges entirely on flawless execution over the next, say, 3 to 6 months. The market has rewarded them for clearing those corporate hurdles. That's done.
The comeback story is written.
Right. Now, management has to convert that momentum into tangible clinical milestones and execute on those other partnerships they've been promising. If they can do that, it validates the long-term value of their entire melanocortin platform.
That sets the stage perfectly for the next few quarters. Thank you for joining us for this analysis of Peloton Technologies. If you want more insights like this, make sure you hit that subscribe button.